All right, we are back, everybody. Let's talk futures. Joining me live, Blue Putnam, Chief Economist, Bayesian Edge. Blue, how are you?
I'm doing well. It's a nice day today. Fall
It
is
is.
arriving.
Yeah, fall is arising. But Blue, I got to tell you, I made the worst currency conversion trade of my entire life.
Well, the dollar strengthened as soon as you took off.
I know, and now I'm stuck with all these euros in my pocket. I guess I'll just keep them in my pocket until something turns around.
I don't know.
So, but ECB cut 25 beeps
They
today,
did.
right? Okay.
They
When
clearly want to get to their neutral rate as fast as possible. And I think it may be actually impacting the Fed to do some of the same.
so okay, so let's talk about that. So what I read this morning was the expectation is that they'll go another 25 cut in by the end of the calendar year.
Yes.
So that'll put them at what 3.3 spot 25 or something like that.
Yeah, I mean, they're ahead of the US in cutting, and they're, of course, a little bit below the US. And we don't want to get too carried away with that interest rate differential. It's not that large. But they are moving a little faster to what they think will be a longer term neutral policy.
So, but if it gets if the difference between the two interest rate policies get too big, then that could affect the import export equation a little bit.
Yeah, but I will tell you that a 1%, even a 1.5, 2% differential isn't going to be enough to be the driving force. I mean, it might have a little bit of an impact, but it's not a driver. What was driving the euro weakness here was just that there was a little bit of a divergence. US data was a little stronger, the ECB still moving it, but what do? We moved from almost 112 to 108. So it's a 3-4% move, but it wasn't huge.
Yeah, I hear you. All right, well, we'll see how it goes going forward here through the end of the calendar year. The game we're all playing, FOMC watch game that we're all playing it's getting a little tiring to be honest with you. And now I feel like the sentiment is right. I feel like the sentiment is, well, yeah, we're going to slow our roll now.
Oh yeah, I think we're the Fed's on a path, and something big has to move it off that path. Which, by the way, won't be the election. They'll try to ignore that as long as they can, no matter which way it goes.
Yeah, well, that's probably a good thing, maybe.
Well, longer term, they're worried about their independence, but they're going to try to stay out of the limelight as much as they can. Who wants to be a political football right now?
Yeah, no, I get it. I know. Yeah, let's talk about the the election year phenomenons a little bit later in the
Okay.
show today because I have a couple of questions for you on that note. But I have a whole bunch. I have bullet points on my pad, and when I looked at your presentation, you're covering them all. So
Oh my
uh,
gosh.
yeah, so which is awesome. So let's just take a peek at that PowerPoint you sent over to me right now and start with the new weekly unemployment claims.
Okay, so we had two hurricanes, and they were particularly Helene was really knocked a lot of people out of work for weeks and maybe even months, and then followed by Milton, who did some damage in Florida. So, when people are working for a shop that can't open or a store, even a factory that can't reopen, they're going to go get some unemployment insurance. So that showed up last week. It's very slightly tailed off this week, but this is, I think, an aberration. Well, if you're in the middle of the hurricane, it's not an aberration, but this is not something the Fed will consider on interest rates. It's not a sign of permanent weakness. It's just that it was two serious hurricanes back to back.
A hurricane, it's hurricane distortions, they're calling it.
Yeah, I guess that's the same thing as AI hallucinations, but I don't know.
So, but I mean, I don't want to laugh at the hurricanes. There's a lot of people without power. A lot
Oh,
of people suffered,
I know.
lost lives and businesses. It's horrible. And I was in Asheville earlier this year, and it was just unbelievably beautiful, great place to be. It had
Oh,
everything
yes.
for adults my age. It was perfect.
No,
You know,
no,
you
it's
had that.
got music, it's got food, it's a fantastic city. And,
Yeah,
it was on the list of cities that were likely to be, flood and hurricane proof. But you dump that much water on a mountain and it comes down much narrower paths. And so
yeah.
we all got a very important education about what happens when you get 12 inches of rain in a short period of time, even in an inland place.
Yeah, yeah. And you don't want to live downhill.
Where you're going to live on top of the mountain and can't go, I don't know.
Yeah, yeah. No, well, I know. That's true. That's a good point. So yeah,
But
I've had
it
friends.
is going to recover. They're going to get everything back in shape. This is not a something that's going to happen all that often. It was a pretty unique experience.
Yeah. Okay. So this little distortion here is not going to probably affect the Fed's calculus going forward.
No, I don't think so. I mean, they're on a path to cut in November 25 basis points, and this isn't going to make them cut more because it's temporary.
Yeah, gotcha. All right, let's keep rolling here. Now, there we go. We got a picture of it.
Yeah. Yeah, the top one is Helene. The bottom one's a different kind of shot of Milton, but these were
Yeah.
both very serious storms. Oh, and by the
Yeah.
way, they'll mess up the jobs data that's going to be released the first Friday in November. It'll probably show a little higher unemployment, a little weaker job creation, and that's the same thing as the weekly unemployment is telling us.
So are we thinking like 4.3 or 4.6 or more subtle?
4.3 would be my guess, but I don't like to do decimal points because you're getting
Yeah.
too precise for my work.
Yeah, no, I gotcha. Okay. Okay. And then of course the insurance industry is another whole.
Oh, yes, these are, they don't cover floods, you know, but there's
Yeah.
still plenty of damage to worry about.
Well, and that begs the question. In some places you could get flood insurance, and in some places you wouldn't think to get them, right?
Yeah, Asheville would probably be one of those places where you wouldn't think about it, but usually comes from the government.
Yeah, I mean, I don't know. I'm down here on John's Island, as you know, and it's we have all sorts of coverage
Yeah.
because I will be swept out into the ocean if something bad happens. Anyway, net new jobs data through September 2024. What do we got here?
This one is, we're looking at what's going to come out on the first Friday in November, and we're looking for that black line, the month-to-month line to push back down toward the bottom end there. But that's mostly, well, it's partly that this number zigzags, so we're due for a zag, but it's also partly the hurricane depressing it a little more. So it might set the low for the month, the year, those kind of things.
Okay. Well, I mean, that kind of begs the question too. It's like we have another at least 6 weeks left in the hurricane season, I think.
And we have a lot of warm water. So if a hurricane forms, warm water evaporates more than cold water. There's going to be a lot of water in that storm and it's going to come down somewhere. But we don't know. There's one out in the Atlantic. I don't think it's going to hit, anything, but we'll see.
Yeah, but sometimes in my experience, they just all of a sudden pop up, right? It's not they're not necessarily on a long-term radar all the time.
For sure. And I would put Milton in that category. It came out of the Gulf of Mexico. It didn't come across from Africa.
Yeah. Yeah. Well, yeah, I was just in Sicily, by the way, and they didn't have to worry about the hurricanes there.
They do. Well, they have to
But
worry about big storms.
well, they have a volcano that's still kind of active. That's a whole nother problem.
That's a whole nother problem.
Anyway, okay, so we're expect again to take a hit, and you said it was this Friday or next Friday? Next Friday.
It's 1st of November.
Okay, so we'll get that print before the next FOMC. They'll probably use that in their calculus a little bit as well. We kind of talked about the unemployment rate a little bit, but now you have a chart that's intriguing here.
Now, I'm just saying that we're going to tick up a couple of tenths. Uh,
Okay.
we're only talking about parts of Florida, Georgia, and North Carolina, and only parts of those states. So it's not going to be that big, but it might be noticeable.
Okay, and you have a question mark. Will the Somme rule work this time?
Oh, I'll probably have to take that off this chart. No, it's not working.
So this is the first time in 12 observations, right?
Well, this is the difference between data mining and data science. The Somme rule is data mined. It's a pattern. It exists. But do we have a good theory? Well, we have a good theory. Generally, when unemployment goes up, it goes up pretty fast. But this time, we're recovering from a pandemic. There's no precedent. So, I would be very, very careful. This economists don't like it when you say this time is different, but it is. So my theory doesn't say that it's going to work this time.
So do you think that some of the extraordinary amounts of money that got popped into the system because of COVID through the government caused this time around to be different?
It definitely impacted it in a big way. The pandemic is obviously the event that triggers everything. But once the pandemic occurred, the government provided a tremendous amount of fiscal stimulus. Former President Trump started it off, and President Biden did one more round. And so you got all total $5 trillion. Uh, so that's going to provide a lot of spending when the economy is partly shut down. So economics 101, demand up, supply not so good. Inflation is coming, but it takes a year. So it did come. The
Yeah,
Fed
yeah.
prevented any interest rate reaction. You issue $5 trillion of debt and then the Fed buys it all. You mute it and you make the whole thing a little bit more severe. All of those things have gone away. So, we're going to go back and figure out what we were trying to do in 2017, 18, 19.
Okay, I got it. But would you say that we're getting close to back to normal, business as usual?
I don't want to use the word normal because that implies exactly the way we were, but I do think we're finding a new equilibrium, which is a little slower economy, fairly low inflation like we had before. So yeah, my answer is yes. We're going back to, let me put this a slightly differently. The transitions that have occurred are almost played out. We had a pandemic, that's over. We had fiscal stimulus, that's over, but it has a long lag. We had zero rates in quantitative easing. Those things are gone, but they have long lags. So just because the pandemic is over doesn't mean the lags from all of these effects or triggers is quite gone. But I would say we're in the last 3, 4, 5 months. We're pretty much putting it in the rearview mirror, which means we're going back to a new equilibrium.
Got it. That makes sense. That makes sense. All right, let's keep rolling. Retail sales came in today, actually.
Yeah, this morning. Up 0.4 for the month. The forecast was slightly lower. I don't know. 1/10 is not enough to get me excited. This is not a super pace. It's a good moderate pace for the economy. I mean, if you multiply zero point 0.4 times 12, you've got a 5% or a 4.5 to 5% nominal GDP type of economy. If you take out 2.5% inflation, you got 2% GDP. Atlanta Fed says we're a little higher right now, but it's a modestly growing economy. Nothing unusual about it. So the Fed
But
can
that,
do its. The Fed can go back to a neutral, wherever that is.
well, and if we keep popping above 2.0 on GDP, then is somebody going to be able to raise their hand and say, "See, I told you, soft landing."
Oh, they're going to be able to raise their hand and say, "I told you, no landing." By the way, my
Okay.
hand's up.
Yeah. I'm on record, man. You can go back to I canceled the recession about 18 months ago. So
Yeah.
I'm with you on that. So, but explain to me one thing. Me and Tom earlier this morning, we were talking about the retail sales number, and we were, from a economic professional point of view. And we were grappling with this idea of, see adjusted versus non-adjusted. The non-adjusted data looks a lot worse. And what's going on? I mean, why did they adjust it in the first place? And then how should we think about the two different numbers?
Well, the big season for all retail companies is, of course, November, December, January. They want to make it during the holiday season. And those can account for a huge percentage of the annual sales of retail companies. So the seasonal adjustment process takes all of that super consumption in the holidays and spreads it over the year. But what that means is, September is not as strong as November, December, so it gets goosed up a little bit for seasonal adjustment. The easiest way to do seasonally adjustment, if you don't like the numbers, is just do year-over-year comparisons. Well, what did last September do?
Okay,
And
so
as you can see from this table, these numbers are not exactly stable. So I would recommend like taking July, August, September, comparing it to a year ago. And if you do that, retail sales are up about 2.3% the last 3 months against the same 3 months a year ago, which is a
well,
little
that's
slower than GDP is telling us.
okay. Okay, that makes
And by the
sense.
way, retail sales, let's be clear, this is mostly goods, gasoline, stuff like that. The only services that are included are bars and restaurants.
Why?
Don't know why. I just know that's the way they do it. It's called advanced retail sales, including restaurants and bars or something like that, food service.
Oh, I frequent both of those, so they should
Yeah.
be included.
Oh, absolutely.
Because the average retail. So okay, so thinking about what you buy on a month-to-month basis, you got your food, you got your gasoline, yeah, you go out
Right.
to restaurants, maybe go to a bar to watch a football game. You'll run house cleaners for your house. Maybe you need some new socks because you got holes in your old socks. That kind of stuff is kind of, in my mind,
Yeah,
regular retail activity.
absolutely. Yeah, and I mean, if you turn the page, you can kind of see the stability over the long term and um, the relationship to interest rates. But it's volatile month to month, but it's not all that volatile year to year unless something happens like a pandemic or 5 trillion of fiscal stimulus.
Okay. And so retail sales though is important when we think about GDP and whether or not we're going to go into a recession or not, right? Because that's the driver of GDP, one of the drivers of GDP.
Retail sales is a very important piece of data for the GDP calculation. Eventually, we'll get to a broader definition of personal consumption, but this is early data and it's very important for how GDP gets calculated.
Got it. All right, let's keep rolling here. Thanks. I appreciate that little sidetrack there. Oh, this is retail sales versus 10-year yields. Good.
Yeah, and when interest rates were zero, retail sales were actually running on a year-over-year basis a little above the 10-year, which was pulled down by zero rates and some quantitative easing. And now that we're in a higher rate environment and with no quantitative easing, teeny little bit of quantitative tightening, the 10-year yield is running a little above retail sales. So I think that pattern has shifted, but um, retail sales do appear, in my view, to have reached that new equilibrium. You can see the distortions of the pandemic and then the fiscal stimulus have largely disappeared.
Got it. I'm a little bit surprised that the longer end of the yield curve, the 10 and the 30, um, over the last, I don't know, 9, 10, 11 days, those yields have actually risen way more than I thought they would. The prices have broke, and I'm wondering if it's because the shorter end of the yield curve is more attractive still.
It is more attractive. The 1 year and the 2 year. If you're worried about the valuations in the stock market, then staying in cash at these, the shorter end is something people are taking a good look at.
Okay, so that explains the lack of demand maybe for the 30 years, an
And we
example.
did get a little better economic data over the last 3 or 4 weeks. So, that calmed the Fed down and all those talk of another 50 basis point cut disappeared totally.
Yeah.
But the
Right.
10-year
Right.
largely doesn't care. It cares a little bit about what the Fed does at each meeting, but it's really a longer term measure, and it knows rates are coming down. It just, like you and me, we don't quite know how far, but they're coming down.
Yeah. So, but you open the door a little bit for equities. Like Goldman Sachs this morning calls for 6,200 S&P by the end of the year. And this is the SPY.
Right.
And I was kind of surprised at that.
Well, it's a pretty aggressive call, given that we don't know what's going to happen on November 5th with the election. I wouldn't take this as a typical year for sure.
Well, okay, so let's talk about that for a second. I know we have some more data here, but um, is there any typical behavior in an election year, regardless of who wins, who's running, any of that stuff? Is there any typical behavior that we see, by the end of, once the dust settles and a new president is elected?
Mostly the year after an election, things do a little better, but
Okay.
mostly means that, we're not necessarily in mostly territory because we have much more polarized and divergent candidates than we have had in the past, particularly on foreign policy, but also now on tax policy and immigration policy. So, you really go back to 2016 and when President Trump won that election, but it was when the Senate and the House became clear that late that night that they were going to go as a full sweep. That's when equities took off, thinking, wow, I'm going to get my tax cut, my corporate tax cut.
Okay.
And that's a little bit in play this time, too, because former President Trump says he's going to cut them, and Vice President Harris says they're going to stay the same or go up a little bit. So, but you have to have the House and the Senate or nothing's going to happen.
Yeah, no, I hear you. In Senate, really the way it's designed, it's a beautiful armor around all of this thing because of the 6-year terms and the 2-year rotations. Robert Caro wrote a great book it's on Lyndon B. Johnson, but it was called Master of the Senate that explains it so well. It's really a nice design here. So to your point, we'll see who controls what.
Right.
Oh boy. All right. So let's keep rolling here. So I have the election stuff straight in my head. Let's let's
Good
let's
luck.
take a look. Yeah, kind of.
I'll skip. This is just that the treasuries are in a wide range. Let's go to the next slide and talk a little bit about what happens after the election that's going to affect things. Okay, so this is before we get there. This is the big gap between where Fed funds rates are and where PCE core inflation is. They got a lot of room to cut. So, you know, that 25 basis points can go for several periods, several FOMC meetings. But I'm a
Okay.
little
So
more worried about what happens in December and then next summer.
but hang on a sec. Is it typical if I go back to 2011, 13, and I'm seeing 100 basis points to 200 basis points separation between inflation and Fed funds? Is that kind of a typical gap?
No, that's never happened before. I
Okay.
mean, the 2010 to 2020 period of zero rates is the outlier when you go back 100 years. That's the
Okay.
period that you're not going to see again.
And then Fed funds picks up above, right? So right now our gap is pretty big to your point.
Yeah, the longer term gap would be somewhere between 0.5% and 1%. So if inflation is 2.5, Fed funds would be between 3 and 3.5. And by the way, I'm talking about the Fed's assessment of longer term inflation expectations. If they think, expectations are anchored around 2.5, then 3 to 3.5 is where Fed funds would end up.
Got it. Okay, that makes sense. Let's keep rolling. Uh-oh,
All
funding
right.
crisis.
This is just fun stuff for the next president. Before you're even sworn into office, there's going to be a funding crisis. The U.S. Congress only authorized funding for the next fiscal year through December 15. So you're going to have a lame duck Congress debating one of the most important topics of the government funding it. And it's going to happen over Christmas. And by the way, they have shut down the government over the holidays before. So this is going to be a very bitter fight, unless something really changes in how this Congress is polarized.
Wow. Okay. So that's yeah, I didn't think of that. I worked for the government for a while. And when we had these crises, a couple times we were furloughed, right? Sent
Yes.
home, and we loved it because we knew it would be resolved and we would get back pay. So it was like a vacation for us.
Well, and a lot of people head straight to Lowe's and Home Depot for their DIY projects. I mean, there would be about 800,000 to 1 million furloughed workers, the quote unquote non-essential. I don't know how that makes you feel. But at any rate, you do know you're going to get your back pay. And so you're not too stressed.
Yeah, no, I could attest to that. All right, let's keep rolling here. We're running out of time, but we have one more snapshot
This
here
is the
about
last crisis that's coming no matter what. The U.S. Congress did not want to have the debt ceiling be an election issue, so they kicked it down the road too to January 1. So on January 1, the debt ceiling is reimposed at the current rate of debt, 35 trillion, give or take. So that means that the government will run out of money after it chooses all its little emergency measures, as they call them, around June or July. So that's when the debt ceiling crisis shows up. And so if the Congress is split between one chamber Democratic, one chamber Senate Republican, you're talking about a crisis on par with what happened in 2011. That's, by the way, when S&P downgraded U.S. debt. We went all the way to the midnight deadline on that one. And then they had a spending compromise that basically capped spending for the next 6 years. So, the deficit actually got considerably smaller after 2011.
Yeah, it begs the question, if they're going to kick the can down the road, why don't you kick it a little further down the road?
Well, there's a saying in Congress that you never want to miss a good crisis. That's when they think they can get stuff done. So they don't like to think long. I mean, the tax cuts of a decade ago are going to run out as well in 2025. All these things, they put sunset clauses on them, and it just means that you have continued uncertainty, particularly in bond and equities because of this.
Yeah, 2025 will be a lot of fun. All right, Blue, listen, we are up against time. I appreciate you spending time with us this morning, this great info. Looking forward to talking to you again. Thanks for being here.
Sounds good. Thank you.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.